Good morning on the last day of November. Stuart, we're getting close to Christmas.
Yeah.
Almost there.
Yeah, looking forward to a break, but let's try and make some investors some money before they go on holiday.
Yeah, let's give that a try. It's the market is tough, I have to say. We've been looking for ideas. We always do, but it's pretty tricky at the moment.
Right.
They're still in a sort of a bear market, I guess. But there's a few stocks. Well, maybe not ideas for right now, but stocks that you want to talk about that could be great turnaround stories potentially. So the first one is Lendlease, Stuart. Tell us about that one.
Right. So I went down to the pound last week and dragged out 3 interesting dogs, which I think we can get rid of the fleas on those dogs and actually make them look pretty good in 2023. The first of those is Lendlease, ASX LLC. It's been a staple of investors now for decades. Top 100 company, obviously. Let's talk about what's to like about Lendlease right now. Who is Lendlease, for those who came in late? Globally integrated real estate group. Headquartered in Sydney, and what they do is what I call develop iconic places. So here in Sydney, there's a precinct down near the harbour called Barangaroo. Lendlease got hold of the whole block, put up 3 massive towers called the International Towers, as well as a whole lot of other smaller buildings round about, and turned it into a destination that people will actually go to, and you can realise a lot of value out of the property in there. There's $100 billion and more in the development pipeline that Lendlease is working on right around the world on projects like Barangaroo. Current CEO is Tony Lombardo. It's probably best remembered for Dick Dusseldorp. Dick arrived here in the early 50s from Mark's native country, the Netherlands. So, Mark, any company founded by a Dutchman's got to be good, right?
It's got to be great. Just like Pitt Street Research and Stocks Down Under. It's got to be great.
Right. So yeah, we wrote about it last September 2021. So probably do an update on this one. But I'm getting pretty excited at what I see right now. Now, that chart looks terrible. I have to admit it. This stock just keeps going lower and lower. It crossed back below its Corona crash lows some months ago and has just kept going south. So what's going on? Let's look at why the dogs are barking in this one. I reckon it's a combination of 4 factors. First of all, COVID-19. That was not good for the property sector. Buildings kept going up, but you kept on getting interrupted by lockdowns, whether you could actually have guys working on site, other issues. Once we got through COVID, we went into a rising interest rate environment. It's always bad for the property sector. So I think people don't want to get involved in anything property focused, be it REITs or other stuff, until they know that there's a bit of stability on interest rates. When you look at the earnings, they weren't great for FY22, a mere 4% return on equity. Now, that don't get freaked out by the number. It should be a bit higher than that, but not double digits, because we're talking about a large amount of capital that sits within Lendlease, which represents the property funds they've got. I'd also say the company's got a bit woke, and you know what they say: go woke, go broke. But it's the first 3 factors that I'd really watch out for, and in particular the interest rate one. Once you see that stabilizing, Lendlease has gone to ridiculously low prices right now and can re-rate from here, I think.
Right. Quick question, Stu. So apart from your personal opinion about being woke, how does a company that gets a bit too woke perform worse than otherwise?
Well, it's more got to do with things like corporate governance than anything else. You insist on a certain number of directors being female or some other minority group, that sort of thing. I have noticed that companies that start being a bit more vocal about their wokiness are often the ones where the stock is going backwards as a general rule. So look, I don't want to make this the hill to die on. After all, my next car is going to be a Tesla. But I'm saying it's always an indication that possibly the company's taken its eye off the ball in terms of driving shareholder value.
Right.
So let's talk about what can go right for Lendlease. Look, the reason to like this one is just the scale at which they operate on. Anywhere in the world where there's an iconic precinct being developed, Lendlease is in there. And they've got oodles of capital with which to create some really iconic destinations that can create shareholder value. $44 billion in funds under management to deploy. Now, that's got a long history. Dick Dusseldorp created the General Property Trust back in the 60s in order to be able to more easily fund developments that he would do within the construction business that he and his colleagues had created. So this is just an outgrowth of something that's been going on for a long time. Company's been working hard on actually getting its cost base down. I think we're going to see work in progress and global pipeline continue to improve. They actually came down a bit in the FY22 year, but we're seeing we actually saw the second half of FY22 do reasonably well. Now the giveaway is this: 5 directors bought stock at the same time as soon as the window opens. That's rare to see that sort of enthusiasm from the board level buying stock. And what's the catalyst here? I think if we get to the first half FY23 result next February, and you're showing a normalizing of return on invested capital and maybe improvement on construction margins, that's telling you that business is returning more or less to normal at Lendlease. In which case, here's the opportunity that you can tap into. We've got double-digit growth for the next couple of years on the earnings front, and yet single-digit numbers on the EV to EBITDA multiple. So I think it's one of those stocks that that traditionally investors have known how to value more or less correctly, but they've lost confidence in it through the last 12 months, and at the right time, this one can turn around and really do some good for the shareholders coming in.
All right. Well, we'll save the biggest dog for last, but I'd say the next one, Stuart, is might not actually be a dog.
This is not a dog, no.
Talga.
Talga Group is another one of those interesting battery minerals plays, which we've seen a lot on ASX. It's clearly undervalued compared to the potential of the projects, but let's just summarize what's going on at Talga Group. This company's foundation assets were a couple of natural graphite deposits in northern Sweden. Sweden's a mining-friendly country. Natural graphite is graphite with a very, very high carbon content, which makes it very easy to turn into battery-grade graphite. So what was the company's genius move? They actually started to bolt on a couple of processing technologies. They could do things with that natural graphite. In a couple of years' time, they'll have Europe's first ever lithium-ion battery anode plant at a place called Luleå, which is up on the Gulf of Bothnia in very northern part of Sweden. It'll be supplying a market in Europe that is desperate to break away from the usual Chinese supply chains for lithium-ion battery components. It's been about 2 years since we wrote about this one, so we'll probably do an upgrade. But I kind of like the news flow for the next couple of years on this company from where it's got to now. So I don't have to tell you, this is the decade of the lithium-ion battery. Both graphite and lithium, the world's going to need about 5 times more of that stuff a decade from now than it is using at present. If current trends on investment in batteries goes the way a lot of experts are saying it's going to go. Importantly, the smart money, and we've noticed this on several ASX listed companies, is betting not just on the raw materials, but on processing technologies that can improve the batteries. The key is that you want to improve energy density. More bang for the buck with every cubic inch of battery space, and you want to be able to charge these things up faster so that you're not sitting around all night waiting for your car to recharge. Importantly, graphite's going to be an important part of the solution for electric vehicle and other rechargeable batteries. For instance, we'll probably need less cobalt in the future, but we're not necessarily going to need less graphite. That's here to stay. So what's Talga got to offer? 3 key technologies, and the first one of these is the most important. Talnode C. They've got a way of coating the graphite onto the anode of a battery to get much better energy density and faster charging. And that's the key material that will come out of that plant in northern Sweden from 2 years from now. But there are other stuff on the boil as well, including something that will actually realize more value out of silicon. Silicon has traditionally been problematic in lithium-ion batteries, but if you can get it to work, you markedly improve the efficiency of a battery. And Talga believes that it's got something there that can make an important difference. So path to potentially serious shareholder value. This is Sweden. So you can get a lot of your power from renewable sources to run any industrial operation. The key deposit's called Vitungi, and they'll take the graphite from there, process it into coated anodes, and they'll be producing about 19,500 tons of the stuff a year. The DFS that was completed last year put a net present value pre-tax in excess of $1 billion on that, with maybe $3 billion in expansion options should the capital and demand be lining up properly for Talga. And the key thing, as I noted before, it's important because Sweden obviously sits within the EU, and EU, like much of the Western world, is pretty keen not to be overly reliant on Chinese dominant supply chains, which is the way we get most of our battery materials at the moment. So you can expect a fair bit of public policy and support for this project as it gets closer to the shovels going into the ground to build the plant.
Right.
$500 million in market cap at the moment, but there's probably more where that came from at the once the news flow really starts to kick.
Right, so $500,000 Aussie. Looking at the NPV, that's over $1 billion US. So say 1.5.
Yeah, there's a $1.5 billion worth of shareholder value if it works. Now, graphite technologies tend to blow hot and cold. If you're buying one of these things when lithium and graphite are coming back in demand, and remember, graphite has been the laggard compared to lithium. Then you can see this thing re-rate potentially 3 or 4 fold from where we are now.
Yeah. So talking about graphite too, just really quickly, there's a few other stocks that we like in that space, right?
Right. BlackRock Mining obviously have a very valuable project that's got all the public policy support you need in Tanzania. They're just completing their funding as we speak. And interesting, it's been a good year for Syra with their Vidalia plant in Louisiana, getting some good offtake from that project. So, and even there was some disorder in Mozambique where the original mine was located, but they've managed to get through those hassles as well. So, right. So anything graphite based that's gotten fairly advanced in terms of the projects is worth taking a look at.
All right, yeah. In the interest of full disclosure, we've got some BlackRock stock personally, just so everyone knows.
Right.
All right. So yeah, we like graphite. All right, so then the dog of all dogs, can I call it that for 2022?
Right.
This one's taken on the chin, left and right, in the stomach, and it's been really hammered down over the course of a year, not more than that, right?
Look, I am so glad that I'm happily married, because I would not like to be out on the single scene again. And my prospective dates ask me what stock you like, and I have to answer Nuix, ASX NXL.
Only one date then, Stu.
I think that would be it. It'd be an early night home after that. So stick with me, folks, while I tell you about why Nuix is potentially worth taking a look at. So yeah, as you can see there, the market seriously dislikes this company. This is a slippery dip like the sort you can ride at Luna Park, where you're only the good news is it seems to be bottoming out there at the right hand side of the chart, but that's about 80 or 90% down from the peak of early 2021, which isn't all that long ago. So what is this company that everyone hates so much? Nuix is a Sydney-based developer of technologies to turn human-generated content into searchable contextual information. A lot of stuff data that humans generate is messy. Emails, blog posts, that sort of thing. To be able to put it into a way that someone can search and get information out of is quite a material achievement. Nuix's technology is good enough to be used by the AFP, ASX, a whole bunch of other spooks out there going looking for trouble. Find this technology valuable, and it's the basis of $150 million a year business. And look at that, Mark, SaaS-based, gross margins 88%. There's only one industry that can rival those sort of gross margin, and it's the pharmaceutical industry. I dare say a lot of SaaS-based companies get pretty good margins, but I wonder if you've ever seen something that high.
Yeah, look, software is typically in that range, right? In the 90s. So this is really good numbers.
Right. So underlying EBITDA 22 million. So in spite of everything that's going wrong, this company is still making a buck. But you can get it at the moment for a mere 220 million market cap, and 46 million of that is net cash as at June 30. And as I noted before, stock is way down what it was January of last year. They've got a new CEO. You would have seen folks would have seen us talking about Infomedia, which was Jonathan Rubinstein's previous company. He left them last year, and he's the new CEO at Nuix, trying to turn this the fortunes of this beaten up company around. So what went wrong? A couple of downgrades in April and May, and that was after a float that had been touted pretty strongly when Macquarie took it public late 2020. CEO quit about a month after that second downgrade. Whenever you get these sort of disappointments, the financial end of the ambulance chases show up in the form of the class actions, and the Victorian Supreme Court just consolidated two of those. So potentially this matter could end up in court. And ASIC are a little bit displeased as well. They're alleging that the board misled investors, and so this company's walked into a few legal problems. Although it's probably more the board at the time rather than the company itself. What can go right? Well, new CEO gets to rebuild the credibility of this company. I'm seeing stable earnings for a start and a beginning of return to growth. So for a product suite as valuable as Nuix, where the stock's been beaten down so badly, I guess because of a few missed numbers, that could be a valuable combination. So very much worth watching for that reason. Believe it or not, a good FY22. So go look at the FY22 numbers. Annualized contract value didn't come down all that much. There was less new business, but more upsell to the existing business. Now, this is remarkable. This company spends about 30 to 40% of its revenue, $57 million in FY22 on R&D. So they are seriously committed to getting the moat deeper, so that they can have the most competitive position in the market they're serving. That actually gives you some flexibility. If you turn that down slightly, profitability looks a whole lot better. Although, I always say, companies should spend what they need to spend in order to make themselves competitive. No debt, 46.8 million in well, a little bit of debt, but 46.8 million in cash. And you've got a new management that's working on a turnaround. So if you look over the FY22 earnings release, it wasn't as bad as the beaten up stock would suggest. Now, what can turn this company around truly? I've noticed that Jonathan Rubinstein, on more than one occasion, has been a buyer of stock. He was in there in September buying it around 65 cents a share, which is roughly where the stock is now. But here's the interesting part. They just had the annual general meeting, and they were able to talk about annual contract revenue and net dollar retention going up. Now, the net dollar retention one is interesting. It means that customers that were with the company last year are actually spending more this year, which is always a good sign. Plus, the company's actually signing up new customers. I think that they're beefing up their sales effort quite strongly, as well as working on next generation products and services to go after in the next horizon of growth. Throw in the fact that the tech sector is bottoming, and Mark, take a look at those earnings numbers. If this is real, if statutory EBITDA jumps off the mere 12 million of FY22 and follows the kind of trajectory that consensus is suggesting, this company's got some pretty good years ahead of it compared to the kind of multiple that the stock's been placed on at the moment. EV to revenue down close to 1. We've seen that last time we saw anything that close. We were talking about 0 a little while ago. This is getting close to that.
Definitely. Look, from a valuation perspective and relate that to EBITDA growth, this one looks like a screaming buy, as you said. And so I like these sorts of stocks. First of all, I'm just mindful that there is these legal issues hanging over the company, right? So you got two things. You got the ASIC lawsuit, and you've got the class action, right? So that's really what you want to get a sense of, is what the damage could be from that, because that could put a dent in company's earnings, right? So if it's 10, 20, 30 million, look what happens to revenues, to the earnings. So that's the big unknown here, which and it could be settled, right? So it is a lot of unknowns here that make me a bit cautious, and I'm always a bit mindful of not trying to catch falling knives. But yeah, looking at the chart, it seems to be bottoming, and so the question is, are you willing to take the risk that these lawsuits are being settled at certain levels, or if they go to court, the company is forced to pay even higher numbers, or will the settlements be at relatively low numbers? And really, I think that's the key for this one, because in terms of just the operations, it seems like things are going going right.
So what I'd say to that is inevitably, if anything's gone wrong with the stock, there's always a class action. And occasionally ASIC gets involved in these things as well. We saw, for instance, in Austell a while ago, ASB, ASIC was annoyed with something that had happened. The penalties ended up being mild for that one. It's more reputational damage when ASIC has something to say. And for the class actions, these things rarely go to court. There's some kind of settlement out of court so that everyone makes money. The ambulance chasers and ultimately the shareholders. They make for interesting news commentary every now and then, but they tend to be more noise than anything else, is what I would say. But not every investor will feel like that. As I say, this stock has a higher level than usual risk around it, and I think we're being priced accordingly. So
yeah, no, definitely. Look, if in terms of risk reward, you definitely, in terms of looking at the chart, let's go back to that chart because that looks interesting, right? It definitely looks like it's been bottoming out. And if we let our technical analyst loose on this, he'd probably say that little jump that you see there towards the end, the green bar, it's probably close to breakout levels.
Right.
So you could argue, yeah, look, from a risk reward point of view, there's probably a bottom in the share price right now. But yeah, the question is how much, even if these class actions get settled, how much is company are they going to have to pay? So look, that's everyone's own decision to make, right? It's definitely very interesting technology to have, but yeah, it's pretty risky at the moment.
Right, and keep in mind as well, the tech sector in 2022 has not done anyone any favors. That's probably bottoming as well. So you might have some tailwinds behind you with a story like this one.
All right, excellent. Well, Stu, thanks. So we had two of the biggest ASX dogs and one really cool graphite play today. Yeah, and so I'd urge you to also have a look at the other stocks, the other graphite stocks we've written about, including BlackRock, because we've done quite a bit of research on that. And I think there's an interview, Stuart, that we did with management, right, a little while ago.
Yeah. So plenty of stuff to learn about graphite. 2022-23 is the year of graphite.
And on that note, we'll wrap it up here. Thanks, Stu.